So how do you calculate your lot size to equivalent pip value? Just to refresh your memory, if for example the euro against the US dollar moved from 1.3924 to 1.3928, it has moved a total of 4 pips. And if the US dollar against the Japanese yen moved from 95.23 to 95.19, it has also moved 4 pips. Now this is fairly straightforward so far. If I was trading one standard lot, which is 100,000 units, then each pip is worth 10 US dollars. So in the earlier example of the euro against the US dollar, with the 4 pip move, and assuming you were trading one standard lot, 4 pips is equal to 40 US dollars. The same $10 per pip also applies to the Great British Pound against the US dollar, the Aussie dollar against the US dollar, and the New Zealand dollar against the US dollar. So that was the easy part. And to keep things simple, I would convert everything over to US dollars and back over to Great British Pounds at the tail end. Now all of the other Forex pairs aren't quite as simple, as the US dollar is not the quote or the counter currency. So what you have to consider here is the currency conversion between the two pairs. And the maths can be a little bit confusing. So to keep it simple, I consider all pairs to have a 1 pip value of 10 US dollars on a standard lot. Just about all Forex pairs except the euro against the Great British Pound have a pip value of less than 10 US dollars, and most of these are just under that level, but they do fluctuate with the different currency variations. Now if you do need to know the exact pip value, then there are plenty of free websites out there with a built-in free calculator to do the maths for you. So let's get straight into an example. So imagine I have 2,235 US dollars in my trading account, and I'm happy to risk 2% on each trade. So I'm on my broker's website, looking at their charts, and I see a nice setup on the euro against the US dollar, where I'm looking at buying in at 1.3928. I'm going to place my stop loss 30 pips below at 1.3898. So my risk on this trade is 30 pips. Now I need to know where my position size will be, where I'm risking no more than 2% of my overall account balance of 2,235 US dollars. So in this case, that would actually equate to 44 US dollars and 70 cents. The easy way to work this out is by using the following. Account balance multiplied by risk percentage divided by risk equals position size. So in this trade, the maths would look something like this. 2,235 US dollars times 2% equals $44.70. Now $44.70 divided by 30 pips equals 1.49. Therefore, my position size on this trade would be 1.49 mini lots. If you're unsure of the position size, whether you're using a standard lot or a mini lot, just do the maths backwards to confirm. You know the maximum risk on this trade is $44.70. So if your number matches up, then you know you've done this correctly. If you went into this trade with one mini lot, you know each pip is worth $1. So if we stopped out, then the most we would have lost is $30, which is under your maximum risk of $44.70. And this is due to the fact you had rounded your position size down. So let's take a look at another example. This has a much larger account balance with a different risk percentage and also a different stop placement. Imagine your account balance is 37,840 US dollars. Your risk on this trade is 3%. You are placing an order to sell the Great British Pound against the US dollar at 1.4562 with a stop placement at 1.4607. Now this is 45 pips away. 37,840 is our account balance, divided by 3%, which is our risk percentage, equals $1,135.20. $1,135.20 is our maximum risk, divided by 45, which is our stop, equals 25.226. Therefore, my position size would be 25.226 mini lots, which is 2.5226 lots, or rounded down to 25.2 mini lots, or 2.52 lots, which is basically 2.5 standard lots. Now let's do the maths in reverse if we want to double check our position size. You know your risk is $1,135.20 and your stop is 45 pips. Each pip is worth 10 US dollars on a standard lot. So if you were to risk 45 pips on 2.5 lots, 45 times 2.5 is 1,125, which is under our $1,135.20 risk. By using this formula, you should never have to worry about margin, leverage, or risk. As I mentioned before, they are completely within your control. They just don't come into it. But having said that, it all depends on your risk percentage levels and your actual trading methods. You do need a successful trading method, because if you don't, and say you were risking 2% per trade, you would eventually blow your account. Risk management there is there for longevity, but you do still need accurate trades in order to come out profitable. For more great content like this, head over to the Tips to Pips website and join our community of over 1,200 traders.